lots do you have? And when you position yourself in a passive or in aggressive side of the market, we can see exactly how many with a multiple entries to sell or to buy the instead of relying simply only on the structure, you need to understand why the structure hits the up and bottom or swipes, because there's a liquidity that's not never visible to the people who only believe or rely on the structure. Now, let me show you what you're seeing right here on the right side. This is DOM. DOM is called the depth of market. This depth of market show you the hidden or passive or limit side of the orders. Those that resting and waiting until the price gonna come and trigger them. Big institutions use that most of the time. You can use it as well with your small orders, but that's what they use. Now, as you can see on this dome depth of market, because the aggressive side of the market is called the top of the book. The passive side of the market called the depth of the book. Okay. Now there is another third level when we can see the depth of the book, but instead of showing the how many orders, we can see individual orders, and that gives us a fantastic, tremendous advantage. For example, you see that there is a like on this very dome, you can see, let me make it a little bit larger. Okay, there is somebody put like four lots, and totally it's 17 because the other ones that I filter out, they're simply ones or twos or anything that below the four. Now you see that this person put actually 10. This one order is 10. This is larger. I can scroll and I can see there's other serious people right now. It is before the market getting close, like in 8 minutes. So the people actually already on this Friday is left the market. But anyway, this is the 12. This is that we're seeing that this person have a 12 lots in order, 12 volumes. Okay. And totally number of the orders, there's a 5 orders. That means there's, let's say, 5 people in that village, okay, or neighborhood. So we can see if there's some orders are very strong, and when they actually sit for a long time, you can see these orders reflected on the heat map over here. So this is the heat map. I filter out insignificant volumes, and this is 51, this is 77. So, but the heat map show us what happens on the passive side on the book of depth.
Interest rates. And I get the sense from all these central banks, particularly in Europe, the ECB and the Bank of England, that that's the situation, that's the tension that they're currently facing.
At a certain point, if you see your economy deteriorating and unemployment going up, what do you do? How do you respond? Do you change your mandate? Right now, the Bank of England voted 8-1 to hold rates where they were, but they indicated that they could be hiking materially. Does Christine Lagarde say the same thing? I'm looking for the color of a scarf to give some indication.
Is that what people do? We used to do that with Draghi and ties.
I think we need to start a scarf brooch approaches. Yes,
Some
that's exactly what it is.
Okay, now typically I wouldn't try and mislead the audience and say, watch the news conference, it's going to be really interesting. The ECB is never really very interesting, particularly the news conference under Lagarde.
But
this one could be slightly different because of the situation they're in and the challenges they face in the Middle East.
How does she message this, given the fact that she has to signal a desire to anchor inflation expectations? But already yields are so high, number one. And number two, the data coming in weaker than expected just this morning, growth coming in weaker than expected, CPI on the margins coming in line, but a little bit higher in certain areas. It gives a sense of their conundrum. Europe is struggling. First it was Asia, now it's Europe. They're struggling, we know, with jet fuel. Petrol prices are going up. They are more reliant on imports from the Middle East. We spoke to the U.S. Energy Secretary this week, who's in Croatia. They're dubbing them Trump peace pipelines, but what they're talking about is just more LNG going to Europe. Second shock after Russia's invasion of Ukraine. Now they're doing with the Strait of Hormuz being closed.
So that's the schedule for this hour. So at 8:15, we'll get an ECB rate decision. After that news conference wraps up, it starts at 8:45. We're going to catch up with this guy. I think an important conversation on the Federal Reserve and the backdrop, the economic backdrop, given the threats we see in the oil market. Kevin Hassett, NEC Director, 9:30 Eastern Time, an extended edition of Bloomberg Surveillance right here on Bloomberg TV.
With gasoline prices near the highest levels that they've been going back a number of years, and this fear that maybe this will impede consumer spending, how does he dovetail both an argument for a Federal Reserve that's going to cut rates with an economy that is strong and delivering above average GDP growth? It is an uncomfortable message to deliver.
Looking forward to that conversation in the next hour. This hour, we'll catch up with Mira Pandit at JP Morgan Asset Management, with oil pulling back from wartime highs. Pooja Kamra of TD Securities with a rate decision looming from the ECB, and Jonathan Pingle of UBS breaking down the latest round of economic data. We begin this hour with stocks edging higher on easing oil prices. Mira Pandit at JP Morgan Asset Management writing oil at 110 to 120 for 6 months could have a 4 to 6% hit to EPS, but that would still leave us with double-digit earnings growth. Mira joins us now for more. Mira, good morning.
Good morning.
It's good to see you. Break it down. Where's that earnings growth coming from right now?
Look, if there's a war, nobody told earnings. That is one area of the economy where we haven't seen a significant decay in light of expectations. And even with some of the expectations that you just highlighted from our various equity analysts across JP Morgan, the range is still pointing to potentially double-digit growth. You started off the year with expectations for 15% year-over-year growth. That's gone up to almost 19%, 18.5%. So you've continued to see those upward revisions. Now, some of that is energy. A lot of that is tech, still being very resilient around that secular story. So we have a lot of buffer here when it comes to profits. And I think that's why even as yields rise, you're not necessarily seeing stocks react.
You alluded to it. If I strip out a couple of energy companies, a couple of tech firms, does it still look as impressive?
It looks slightly less impressive, but nonetheless, I mean, that earnings story is getting very concentrated. So we do need to be mindful of that, but it is still broadened out overall. So if you look at the overall Mag 7, that in and of itself is a concentrated story. A lot of that around semis. You take just one of those Mag 7 companies out for this quarter, and that 22% growth rate falls to about 6.5%. Which is not great news when we think about the diversity of earnings growth within the Mag 7. But if you look at the S&P 493, you're still seeing double digits there. You strip out any other semi from that 493, and you're still just right around that double-digit mark. So you do see some broader contributors here and some other different sectors that are participating. A lot of them still linked to AI, but at least now it's not AI in one or two companies. It's AI kind of permeating through the system.
Is this backward looking? Is this ignoring the oil prices that we see now? Should they persist for another couple of months?
Well, a lot of those estimates that we cited are assuming that oil prices stay at these elevated levels for 6 months. So it does assume a more extreme scenario. And again, even if we add a few percentage points to that, the buffer is so strong. And again, the secular growth around AI is so strong and broadening out that it will take more of a shock. And I think what's been interesting is this rolling 4 to 6 week timeline where it seemed like in the beginning, if we get to April, mid-April, and the Strait of Hormuz is still closed, we're going to be in big trouble. And that timeline keeps getting pushed out. So clearly the economy, the markets, earnings overall are a lot more resilient to oil shocks than perhaps we originally expected.
I love this comment. Just it needs a different kind of shock. What other shock do you need? You have your inflation shock, you've got your geopolitical crisis, and now you've got a potential rate shock. Could some of the moves that we're seeing in the bond market serve as perhaps a trigger to change this picture?
If we see rates move a little bit higher, and if that's because of some changes around Fed expectations, that's typically what we do see unseat the market. If all of a sudden a hike becomes a very real probability, then that is going to be very much a troubling signal for the markets, not necessarily just where yields are, but what that signals about monetary policy. But I do still believe that from a Fed perspective, the next move is more likely to be a cut than a hike. We're in a very different situation than we were in 2022. Obviously, the starting point from inflation and the direction of travel is likely different than it was in terms of intensity back then. But you also have a consumer that's a lot weaker. The excess savings has dried up. The savings rate itself is depressed. You have a labor market that's not particularly strong, wage growth that's moderated. And when you look at expectations around inflation, the fear here is does headline feed into some of these inflation expectation measures? But you look at 5-year forwards, you look at 5-year break evens, they've increased about 15, 20 basis points since the war broke out. So a little bit of pressure there, but nothing that's running away here. And I think ultimately what might happen, not only here in the US, but probably overseas if we think about Europe, is that higher headline inflation because people are spending more on gas and food starts to feed into core. And that actually keeps a bit of a lid on core because people are cutting from other areas.
But you say it could peak around 4% this summer, inflation. So how can they cut in that environment?
Well, I don't think the cut is on the table necessarily for this year. Maybe at best December, depending on how things play out, probably pushed out into 2027. But if we think about how we get to 4% back to the twos by the end of the year, probably the upper twos, well, we have a couple of different factors here. You have a bit of the flip side of energy prices that we do think will subside, maybe not all the way back down to where we started the year, but make some progress there. We're seeing that the tariffs will likely start to see a bit of that draining out further, the flip side there. We've had less immigration, so less demand to the overall economy. You continue to see rents soften. So we could very well be in a position where that inflation rate starts to come back into the 2% range, which means the Fed still has to wait and see, but it puts them in a better position by the end of the year to think about cuts for next year.
We spoke to Eric Rosengren moments ago, former Boston Fed president. about Chairman Powell staying on as a governor. What kind of institution is Kevin Warsh inheriting here when he takes over in June?
When you have Chair Powell staying on, he's certainly very much emphasized the point about the legal actions against the Fed and wanting to maintain the sanctity of that institution. I think the role he'll actually play on a day-to-day basis is a little bit more moving from your high school principal to your guidance counselor here, where he's going to try to help build some consensus and, certainly really try to protect the institution. But I do think that, look, the consensus building is an important aspect of the Fed, but maybe we had a little bit too much consensus building in the earlier part of this decade that could have helped prevent a policy error had there been a little bit more debate. So I do think that the debate element that Warsh will infuse into this committee is probably going to be a good thing when we think about the two-sided risks here.
Mira, it's good to see you. Thanks for breaking it down. Great summary. Mira Pandit there of JP Morgan Asset Management. I welcome it. We complained about it for ages. The groupthink of the Federal Reserve, the lack of groupthink in the last 24 hours was pretty welcome.
Yeah, I mean, look, this was exactly what Kevin Warsh said he wanted. Can we give a victory lap to Mira Pandit? Moving from principal to the guidance counselor.
Yeah.
That is an analogy that has so many wonderful ways to play it that I plan on really
spends more time in that office of the Federal Reserve. Got any thoughts? Don't answer right now.
What, me?
Yeah, who would spend more time in that office seeing the guidance counselor?
Oh, among
the FOMC members.
Oh, yeah, I can. Oh,
yeah.
Mm.
Exactly.
Okay.
All right, let's get you an update on stories elsewhere this morning with your Bloomberg brief. Fonnie Quinn has more. Hey, Fonnie.
Hey, John, thank you. Stellantis shares sliding as investors look past a return to profit, questioning the sustainability of an apparent turnaround. Despite improved sales, analysts warn the numbers were padded by price cuts and a one-time €400 million tariff refund. The U.S. war in Iran has cost $25 billion so far, according to a senior Pentagon official. The cost includes spending on Operation Epic Fury, with most of it going to munitions, as well as operations, maintenance, and equipment replacement. The White House expressing opposition to a plan by Anthropic to expand access to its Mythos AI model to about 70 companies and organizations. Sources telling us here at Bloomberg, officials are concerned the company lacks the compute power to guarantee security. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. More from Vonnie a little bit later. Up next, the morning calls. Plus, the latest rate decision from the ECB. We'll break it down with Ollie Crook over in Frankfurt. We'll catch up with Pooja Kamrat of TD Securities in just a moment. From New York City this morning, good morning.
What is going to be the consequence for U.S. markets? We don't see modest gains across European equity markets. Take a look at how we're faring when it comes to Asian markets.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Equities doing better and better. Near session highs up by 0.5% on the S&P, the Nasdaq higher by 0.6. That's the price action. Here's your morning calls. First up, JP Morgan downgrading Meta to neutral, citing concerns about the company's massive AI spending plans. That name's down by 9%. Your second call from TD Cowen raising its price target on Alphabet to 450, seeing an inflection point in its monster cloud results. That stock is up 8%. And finally, Bank of America raising its price target on Amazon, anticipating more optimism on AWS capacity returns. That stock is up by 3.5.
Yeah, just important to note that Amazon's actually the biggest winner so far this year, up 14%, as it turns to more chip manufacturing and building out some of its cloud. I remember last earnings season, we were really skeptical of Amazon because they were announcing this huge CapEx spend and they were behind, and people were saying, they're behind, they're never going to catch up. Well, guess what? They're catching up, and they're catching up fast, and they're being rewarded.
This is what's insulating this equity market from some of the drama elsewhere. Let's get to some of the drama elsewhere. Another central bank decision, this time from the ECB, the European Central Bank, keeping interest rates unchanged, but some nuance here and some headlines we need to work through. So let's head over to Frankfurt at the ECB and catch up with Bloomberg's Ollie Crook for more. Good morning, Ollie.
Yeah, good morning, Jonathan. We're getting, as expected, the rate decision from the European Central Bank, leaving rates unchanged. This was never really regarded as being a live meeting for the European Central Bank. But what we're getting here from the statement, really saying that downside risks to growth have intensified, upside risks to inflation have intensified, and then they're not pre-committing to any particular rate path. That is the ECB using very, very cautious language ahead of a meeting where it's very hard to predict where inflation is going for the ECB. For the ECB, what they have done is they have said structurally here, we're looking at three basic scenarios. There's the good, there's the bad, and there's the ugly. And initially, last week, we heard from Christine Lagarde. She said that the situation in terms of inflation, where they think it's going, is between good and bad. From the data we've seen over the last couple of hours, John, we've got GDP data out of the Eurozone, a number of different countries, in addition to CPI data. Just look at what happened in France. France was supposed to grow in the first quarter by about 20 basis points. That came in absolutely flat. They were supposed to get inflation of 2.3%. We got 2.5%. That is the kind of stagflationary dynamic within some of these European economies that the ECB is going to be very, very cautious about. And we should say they're coming at this basically in real time. I mean, we woke up this morning on the day of the ECB rate decision with Brent at $126 a barrel. So what we're going to be watching very closely a little bit later is that press conference with Christine Lagarde. I suspect she knows what all the questions are going to be to her. I doubt that she's got all the answers.
Ollie Crook, thank you. Over in Frankfurt, Ollie's going to get in that news conference for you. That news conference with President Lagarde starts in just under 30 minutes' time. This is the central bank dilemma. You can't offer much guidance. You have to take a meeting by meeting approach because you've got absolutely no idea what's going to happen in the Middle East, how embedded price increases might become, or how to respond when this happens. Upside risk to inflation, downside risk to growth. And on both sides, they've intensified.
And we already are seeing it in the data. Earlier this morning, we got GDP data coming out of Europe. It came in weaker than expected. We had CPI, 3% year over year, increasing steadily, given the energy shock that you're experiencing. So what I'm curious, how much did you have some sense of what instruments they're planning to use? They said they stand by ready to adjust all instruments. Are they going to start to adjust some of their language to reflect the weakness that potentially could arise?
Let's get to this conversation with Pooja Kumar of TD Securities, joining us now from London. Pooja, welcome to the program. The ECB and the Governing Council believes they're well positioned to navigate the uncertainty. Do you think they are?
I don't think any central bank is right now. ECB did give us a proper model with 3 scenarios and how they are supposed to react. And as we previously mentioned, we are staying closer to the worst scenario, which means that there are small second round impacts. But I think at this stage, the market is so delicate that even if ECB wants to hike rates, like even a 25 basis points means that markets need 100 basis points. I think how to communicate is going very tough this time.
We've seen it in recent data, Pooja. You can see the consumer expectations over the short term for inflation have risen. The ECB is acknowledging that right now. To anchor inflation at 2% over the medium term, Pooja, do you think that will require interest rate hikes?
So, as we said, that ECB is working on a model, and whatever they told us in terms of the surveys, which is the inflation surveys as well as the PMIs, they are giving us indicators that there might be second round impacts that they cannot actually shy away from. I think for me, it's still that they would try to they need more data, right? We don't want to act much in terms of just one data price. I think that will be the language. But for us, it's very clear from whatever we've heard from ECB so far is that inflation is still primary. They are ready to actually keep growth secondary right now. I think they've all suffered in 2022, so they don't really want to take the risk.
Which are you surprised that long-term yields keep going higher, even amid concerns about some sort of suppression to growth?
No, definitely it is something that we are really closely watching. And I think that's why if you see after the March central bank meetings, most of the central banks try to take a step back and try to actually soothe the market a bit. But if you just put the oil chart and a rates chart, they're actually moving just with 100% correlation right now. And that's the key thing. If you do not put a lid to oil prices, it's very hard to put that lid on the rates unless we get something more decisive from central banks that they are able, that they are able to say that this is just a supply shock and the prescription is not just to hike rates. It's not a demand driven inflation right now.
Right now, we are seeing a bit of a bid into bonds, in particular German bonds. You are seeing prices go up, yields go in after rising to some of the highest levels that we've seen going back to 2011. Pooja, is this enough coming from the ECB? Just the suggestion of the dual risks coming up, even without moving. Is this enough for them to just kind of maintain that optionality for the foreseeable future?
I don't think that will be the case. I think as far as we know, Lagarde is concerned, she will still try to say that they're still waiting for data points. But for me, the key risk is that, yes, we have lots of data points coming into the June meeting, which is one more consumer survey, one more PMI report, and one more CPI report. And also the fact that this is the time that hawks have become much more vocal, right? So even if today's conference is kept a bit more neutral and data dependent, we'll all be conscious as to how different groups of the central bank come in next week, just given the fact that we know that this crisis is not ending anytime soon.
Pooja, what can we learn from the ECB and how they dealt with the other energy shock with Russia's invasion of Ukraine?
I think at that stage, what we learned from that time was that they managed to anchor inflation primarily because the demand shock wasn't a case in Europe. So, they just had to tackle the supply part of it. I think the situation is exactly the same when it comes to Europe right now. We did have a big German fiscal spending last year, but we can see the demand has still not moved at all. So I think in Europe, the lower wage growth, the lower growth, the low productivity potential as compared to US and UK does suggest that that spiral effect is not going to be there in Europe. But we also know ECB is laser focused on inflation right now. So they will be possibly the first to act, but they might have to reverse it just because the real economy is not exactly the same as compared to 2022.
Pooja, good to hear from you. Thanks for the reaction to the ECB decision. Pooja Kumran there of TD Securities. Yields are lower today across the curve worldwide, not just the US, but Europe as well. Crude is helping to encourage that move. Crude is pulling back from wartime highs that we hit a little bit earlier on this morning. But also I'd say this as well, it's always relative to expectations. It's difficult to out-hawk. Pretty hawkish pricing for the ECB and the Bank of England coming into these two decisions.
Yeah, buy the rumor, sell the news. At what point are we talking about that type of reaction? That said, I do think it's notable that this is enough to calm market expectations of longer term inflation, at least in the margins. And you could say we're getting no signal whatsoever because it's all driven by oil prices. So what are we even talking about here with central banks? Ultimately, they've lost control. And they're saying, as we've lost control over the situation, we're going to step back and we're in a position to do so. And right now, you're not seeing inflation expectations run away over the long term. For now, at what point does that change, given the fact that in some places, the strength in the economy is enough to keep some of the inflationary pressure?
I think we've said it 1,000 different ways already this morning. First and foremost, they want to anchor inflation expectations. That's their job. But you can sense the reluctance to actually hike interest rates at these institutions. As for the other headlines, I've got to get to this from Meta. Meta's spending a lot of money. That's not news. You know that. This is the news. 6-part bond offering from Meta. They're kicking that debt sale off this morning. And we know what they're looking to raise. They're looking to raise as much as $25 million from that bond sale. They are not alone.
And this is why people have said you can throw anything at this market and it will just take it. I'm looking right now at investment grade bond spreads, the extra yield over benchmark rates that people demand to own investment grade debt. It is 80 basis points. It is less than 1%. It has gone down through this, even with the bonanza of debt sales, not only from corporates, but also from governments, and even amid all the concerns with respect to oil prices. So you look at this and you start wondering, is there going to start being pushback by investors to CapEx plans that are filling the holes that are made by inflation and potentially concerns about what the business model really looks like going forward?
Which market, which investors? Because right now, in the bond market, to your point, we've seen great demand for these debt offerings whenever they come from these big companies. For the equity market, not impressed this morning. Meta down by close to 9%, the smallest bounce off the low this morning.
Yeah, and not necessarily impressed with the fact that they're increasing CapEx without a real plan of exactly how they're going to use it. At this point, does this continue to be a repeat of what we saw late last year, although just for Meta, while the likes of Alphabet continue to do really well?
Geopolitics really hitting Meta on two fronts, the components you talked about earlier, but also the fact that some of their subscriber growth and advertisement has been hit. What's going on when it comes to Russia and Iran, they talked about yesterday. So tough spot.
Economic data just around the corner. That data drops in about 5 minutes' time. The news conference with ECB President Christine Lagarde coming up in about 20 minutes' time. Then 1 hour from now, got to repeat this programming note, NEC Director Kevin Hassett joining us on an extended edition of Bloomberg Surveillance to accommodate that conversation following quite the announcement from Chairman Powell yesterday in the news conference. The chairman is heading to the exit as the chairman. He's sticking around as a governor. Controversial move from the Fed chair. We'll get the reaction from the White House a little bit later this morning. Up next, the data and reaction with Jonathan Pingle of UBS.
While the incoming information has been broadly consistent with our previous assessment of the inflation outlook, the upside risks to inflation and the downside risks to growth have intensified. We are committed to setting monetary policy to ensure that inflation stabilizes at our 2% target in the medium term. The war in the Middle East has led to a sharp increase in energy prices, pushing up inflation and weighing on economic sentiment. The implications of the war for medium-term inflation and economic activity will depend on the intensity, the duration of the energy price shock, and the scale of its indirect and second-round effects. The longer the war continues, and the longer energy prices remain high, the stronger is the likely impact on broader inflation and the economy. We remain well positioned to navigate the current uncertainty. The euro area entered this period of surging energy prices with inflation at around our 2% target, and the economy has shown resilience over recent quarters. Longer-term inflation expectations remain well anchored, although inflation expectations over shorter horizons have moved up significantly. We will closely monitor the situation and follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook and the risks surrounding it in light of the incoming economic and financial data, as well as the dynamics of underlying inflation and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. The decisions taken today are set out in a press release that is available on our website. And I will now outline in more details how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. The euro area economy was showing some momentum when the current turbulence started. Real GDP grew by 0.1% in the first quarter of 26, according to Eurostat's preliminary flash estimate. Domestic demand remains the main driver of growth, supported by a resilient labor market. However, the economic outlook is highly uncertain and will depend on how long the war in the Middle East lasts and how strongly it affects energy and other commodity markets, as well as global supply chains. The incoming information suggests that the conflict is weighing on economic activity. Surveys point to slowing growth, and consumers and businesses have become less confident about the future since the war began. Longer delivery times and rising input prices suggest supply chains are coming under pressure. Looking ahead, high energy costs are expected to continue to weigh on real incomes, making households and firms more reluctant to consume and invest. While unemployment remained close to historical lows in March at 6.2%, labor demand has cooled further. At the same time, households are still benefiting from a solid financial position, and investment should continue to be underpinned by governments spending more on defense and infrastructure, and by firms increasingly investing in new digital technologies. This favorable starting point provides some cushioning against the fallout from the war. The Governing Council highlights the urgent need to strengthen the euro area economy while maintaining sound public finances. Fiscal responses to the energy price shock should be temporary, targeted, and tailored. Reforms to enhance the euro area's growth potential Completing the savings keep funding innovation, supporting green and digital transitions, and improving
Hello.
productivity. The digital euro.
Good morning, brother.
Tokenized wholesale central bank money.
Okay, man, been busy. How are you?
Competitiveness and financial integration, and will boost innovation.
Yeah,
It is
yeah, right now the Christine Lagarde, the European Central Bank lady is speaking about
simplifying and how much
yeah, there was some news this morning. Let me see. 8:30 was released GDP growth here, some inflation and
3% in April,
um
2.6% in March,
but
1.9%
yeah, man.
in February. The rise
What
has
have you been
driven
up to?
by surging energy prices caused by the war in the Middle East. Energy price inflation jumped to 10.9% in April after 5.1%.
Yeah, you can stop by probably
to 2.5%
about
in April.
hour. Do you have
Inflation
Yeah.
excluding energy and food
um
increased to 2.2%.
okay, yeah.
4.3% in March, reflecting a
Yeah,
fall in services
I'm over here at the plantation, so
to 3%.
yeah, just
Services inflation, which declined to 3%.
I'll see you, man.
3.2% in March.
Bye.
Goods inflation went up to 0.8% from 0.5% in March. Indicators of underlying inflation have been in recent months. For now, the ECB's wage tracker and surveys on wage expectations continue to indicate easing labor cost in the course of 26. At the same time, surveys indicate an increase in other cost components and in selling price expectations. Inflation expectations have moved up significantly over shorter horizons. Most measures of longer-term inflation expectations stand at around 2%, supporting the stabilization of inflation around target in the medium term. The increase in energy prices will keep inflation well above 2% in the near term. As the period of high energy prices extends, the likely impact on broader inflation through indirect and second-round effects intensifies. We will therefore closely monitor the size and persistence of the energy price surge and how it feeds through to price and wage setting, inflation expectations, and overall economic dynamics. The risks to the growth outlook are to the downside. The war in the Middle East remains a downside risk to the euro area economy, adding to the volatile global policy environment. Prolonged disruption of the supply of energy could increase energy prices further and for longer than currently expected. These factors would erode incomes and make firms and households more reluctant to invest and spend. The drag on growth would intensify if the closure of major shipping routes were to cause acute shortages of key inputs that forced euro area firms to curtail output. A worsening of global financial market sentiment could further dampen demand. Additional frictions in international trade could exacerbate supply chain disruptions, reduce exports, and weaken consumption and investment. Other geopolitical tensions, in particular Russia's unjustified war against Ukraine, remain a major source of uncertainty. By contrast, growth could turn out to be higher if the economy proved to be more adaptable to the disruption caused by the war in the Middle East, or if the conflict were resolved more quickly than currently expected. Moreover, planned defense and infrastructure spending reforms to enhance productivity, euro area firms adopting new technologies may drive up growth by more than expected. New trade agreements and a deeper integration of the single market could also boost growth beyond current expectations. The risks to the inflation outlook are to the upside. If energy prices were to rise by more and for longer than currently expected, euro area inflation would increase further. This could be reinforced and become more persistent if higher energy prices were to spill over by more than expected to other prices and to wages, if longer-term inflation expectations were to rise in response, or if global supply chains were disrupted more broadly. Ongoing trade tensions could also give rise to more fragmented global supply chains, curtail the supply of critical raw materials, and worsen capacity constraints in the euro area economy. By contrast, inflation could turn out to be lower if the economic effects of the war in the Middle East prove to be more short-lived than currently expected, or if indirect and second-round effects proved less pronounced. More volatile and risk-averse financial markets could weigh on demand and thereby lower inflation as well. The war in the Middle East has caused significant volatility in global financial markets. Overall, financial conditions remain tighter than before the war. The cost of issuing market-based debt rose to 3.9% in March from 3.5% in February. Bank lending rates to firms, based on data recorded prior to the war, edged down to 3.5% in February, while mortgage rates remained at 3.4%. The annual growth rate of bank lending to firms increased to 3.2% in March from 3% in February, while the growth rate of corporate bond issuance fell to 3.9% from 4.5% in February. Credit standards for loans to firms tightened in the first quarter, as reported in our latest bank lending survey for the euro area. This tightening was due to banks becoming more concerned about the economic risks faced by their customers. Demand for loans to firms decreased slightly in the first quarter, especially for fixed investment. Mortgage lending grew by 3% in March, after 3.1% in February, amid a small tightening in credit standards and unchanged demand. So, in conclusion, the Governing Council today decided to keep the three key ECB interest rates unchanged. We are committed to setting monetary policy to ensure that inflation stabilizes at our 2% target in the medium term. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. Our interest rate decisions will be based on our assessment of the inflation outlook and the risks surrounding it, in light of the incoming economic and financial data, as well as the dynamics of underlying inflation and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation stabilizes sustainably at our medium-term target and to preserve the smooth functioning of monetary policy transmission. And we are now ready to take your questions.
And the third question goes to Mark Schroers of Bloomberg Markets.
Yes, thank you. President Lagarde, the statement says that the upside risks to inflation and the downside risks to growth have intensified. Where does this leave the ECB, this new risk assessment leave the ECB between its baseline, its adverse and the severe scenario, and what does it mean for monetary policy ahead? And related to that, would you say that a rate hike in June, as expected by markets and market economists, isn't it the most likely outcome unless there is a quick end to the war and energy prices fall back quickly and significantly? Thank you.
I think we would all wish that there was a quick end to the war. But looking at our monetary policy and the decision that we made today, we decided to keep the 3 interest rates unchanged. And to address your question, I'm not going to tell you whether we are closer to the baseline scenario 1, scenario 2, because I think that what we have debated over the course of yesterday and today with the Governing Council is where are we relative to the baseline? And the conclusion is that we are certainly moving away from the baseline. Where to exactly, at what point in between baseline and other scenarios is, I'm not sure, the most relevant assessment. We are moving away from the baseline. And what is critically important is the impact that energy prices will have. I said last time in March that it would be a question of the duration, the depth, and the propagation. And this is clearly what we need to better assess. If I was to summarize for you what we decided today, I would say that we made an informed decision on the basis of yet insufficient information. So why do I say it's an informed decision? It's because we debated at length and in depth various options. We debated the decision that we have unanimously taken today, but we also debated at length and in depth a decision to possibly hike. So that was debated amongst all governors. And I'm sure that you will meet some governors who will argue both sides, or maybe one side of both proposals. So it was really a deeply discussed monetary policy stance, of which the outcome was a unanimous decision to leave the 3 interest rates unchanged. And I'm saying that it's an informed decision based on insufficient information. It is caused by the fact that while the hard data is broadly in line with our projection and what we discussed here back in March, but there is such uncertainty that we need to understand and revisit all of that at our next monetary policy meeting. And we believe that given the position we're in, we are saying in the monetary policy statement that we started from a good position. We were well positioned to navigate. So given that position, we believe that this 6 weeks will be the right time to assess the development, to understand in particular the outcome, possibly, of the conflict, or if there is no outcome, that in and of itself will be informative, in order to make an informed decision on verified and revisited information that we will receive in the next 6 months. That's the clearest way, I hope it was clear, that I can describe for the really good discussions that we had both yesterday and today.
Next question to Annette Weiss-Barossin. Annette, please.
President Lagarde, thank you for taking my questions. I have a question on whether you have also discussed that the risk of a stagflationary scenario in the euro area and how that discussion went. And also in the US, they are starting to also think about shrinking the balance sheet instead of using interest rate as a monetary policy instrument. Do you look into using other instruments as well instead of just hiking to alleviate
European banks are resilient, and we do not believe that liquidity or capital is any sort of limitation for lending. And this is something that we have analyzed quite in detail. So I would say that that we are confident that they have enough liquidity, that they have enough capital, and that they are meeting the purpose of that we wanted to deliver. That is that banks meet the needs and the financial needs of families, households, and corporates. You referred to private credit. Well, we are going to dedicate a full chapter of our financial stability review to private credit. It's something that is catching the eye of markets because of some liquidity issues. Private credit is a totally different animal in comparison with the banks in terms of oversight, in terms of the way that they function. And we are going to analyze, interlinkages between private credit and other players, as insurance companies, as the banks, and with private equity. And I think that you will have, a full explanation of our approach and our assessment of the potential financial stability risks posed by the private credit in our financial stability review that is going to be published in 3 weeks.
Next question. Sorry. Next question goes to Olaf Staubeck, the Financial Times. Olaf, please.
Thanks for taking my questions. My first question is on a scenario that some economists discuss at the moment, which is basically a return to the 2011 scenario, where the ECB hiked relatively early on, then had to reverse after finding out that it basically pushed the economy into stagnation. Is this a scenario which is on the governing council's mind, and has it been discussed? What are your thoughts on that? And my second question is also to the Vice President on cross-border banking mergers in the euro area, which has been, I think, kind of a favorite topic of the ECB in recent years. We now have a situation where the German government is quite openly opposing a potential merger. Do you have any views on those kind of actions of the German government, or what, at least the position? Thanks.
Well, thank you for your first question. We, around the table of the Governing Council and the staff of the ECB and the Euro system, is very attentive to our history. We don't have a long history, but we are paying attention to what has been done in the past. And you might argue that we, learning from history, will want to stay away from the risk of being too early. That's your reference to 2011. And the risk of being a little bit too late. And that's what some of you would characterize for 2022. I would like to debate that forever, of course, but that's where we are. And we are going to be very attentive to the data, very attentive to the inflation expectations, very attentive to the supply chain disruptions, very looking into the depth of the wage agreements and the collective agreements that will be negotiated in the next attentive to setting factors. And there's a whole range that we will be paying attention to in the next few weeks. And they will be to be certain that from the good position we're in, we have the right occupant, because our determination to bring inflation to the such agenda. There is an awful amount of uncertainty. Things might change, for the good or for the bad. But one thing is certain: we are determined to return inflation to 2%.
And Mr. President, if you look at the reply of the system to the consultation process that was launched by the European Commission a couple of weeks ago, we published a couple of weeks ago,
you will realize that the main message that is embedded in that report is that we are in favor of a single jurisdiction for the European banks with free flow of capital and liquidity. In that, referring to the deal that you have indicated that you have alluded, well, I think that this principle applies very clearly.
Next question now goes to Jean-Philippe Lacour of Agence France Presse, AFP. Jean-Philippe, please.
Thank you, Wolfgang. Bonjour, Madame la Présidente. I'm wondering why in the statement there is this sentence, the Governing Council will closely monitor the situation. We were speaking about history. I remember the Trichet times when he said we are looking very closely the situation. It was a pre-signal for a soon rate step. So I'm wondering why the need to add this in the communique. What was the rationale behind this today? And on the other side, on my second question, there is a stagnation in the economy, or quite a stagnation of the Eurozone economy. If
my lifetime. And I think that we have that opportunity again, and it would be a shame if we squandered it.
So you think that it is appropriate to currently cut rates, despite the increasing concern by some of the Fed members that we are entering a potentially inflationary moment? Do you think it's inappropriate to go to something more of a symmetric type of approach?
Well, they've been sort of saying we're leaning towards cutting, and then there was some dispute about what's going to happen at the next meeting. But I think that getting interest rates down could really supercharge the economy from where we are, but not be super inflationary. So you saw that the weak spot in the GDP report was residential investment, which was down 8%. Residential investment is kind of the most interest sensitive thing there is. And I think that Fed policy had the chance of moving the yield curve in a way that could really help home buyers. And one of the things that I remember from the 90s is that when we want to have sort of low inflation, high growth, then one of the things that happens is you get a lot of construction, residential construction. And when you have residential construction, it has a big positive effect on GDP because you have like an empty house that has to get filled with a washer, dryer, and a TV and carpet and furniture and everything else. And that's much different than if you have like an old house where you're moving from one old house to another. And so new construction is really the thing that could lift this to 4 or 5% growth, and it's being held back by interest rates.
What's the pathway to get there, given the fact that the longer term yield curve is seeing some of the highest rates that it has this cycle, 5% in the 30-year yesterday for the first time in a while. And frankly, a lot of people in the market think that if the interest rate were cut at the front end, that would only exacerbate the creep higher in yields at the long end. How do you see that?
Yeah, I mean, there are times when that's true, but not a time when we're in the middle of a huge positive supply shock. And so I think a little bit of movement, and Kevin Warsh, hopefully soon to be Chairman Warsh, has described how one can do that and maybe play with the balance sheet a little bit at the same time and move things in a direction that helps America's homeowners. And I think that if we could get that last little bit of the economy going on all cylinders, then we'd really be back very close to talking about the golden age.
Kevin, we have triple divot crude this morning, WTI, much higher. And actually what you're seeing across America, especially in a place like California, they've actually breached $6 a gallon when it comes to gasoline. I know the White House has some measures. They've extended the Jones Act waiver, but what else are you thinking about?
Well, we've already done a whole bunch of things, including, basically opening up the drilling that was offshore drilling in California that was shut down by the state, and that's actually alive and pumping out barrels. The bottom line is that we're very convinced that this is a suicidal Iranian regime that was set on really big disruptive things in the region that would be perhaps permanently harmful, and that when we had them signal in their negotiations that they were just about ready to have 11 nuclear bombs, then the president decided to take action to defend the entire earth, for goodness sake. And so right now, the thing that I look at as in terms of the economic effects of the war is how difficult it is for Iranians right now, as if the government doesn't care about them at all. And so they're having a hyperinflation, they're running out of food, they don't have any distilled product to drive around in their cars, they're shutting down businesses, even the Persian rug dealers are shutting down. It's time for that government to just see that they shouldn't aspire to have a nuclear weapon, and if they just give that up, then we can go back to having normal relations.
Right, but what could this government do to shield Americans from higher gasoline prices? Are things like an export ban on the table?
No, what we've done is we've, as you know, we've done the Jones Act. We've opened up drilling in California. We've, pursued changing the ethanol standards so that the corn ethanol can be used more in the summer. We've taken every single step that we can, and we understand that it would have been a lot worse if we hadn't done that. But the fact is that our expectation is that things are going to get better very, very quickly if we could just get the Iranians to finish the negotiations and realize that it's in the interest of their own people to stop things that could turn into serious hunger events and so on.
Kevin, unfortunately, and you and I are probably in agreement here, unfortunately, they've got a track record of doing a lot of things that aren't in the interest of their own people. In the meantime, there seems to be a preference to maintain the blockade and put the squeeze on them. How close are we to them breaching storage capacity, so to speak. What's our understanding of that? Do we have a decent gauge of where things are at inside the country?
It's a well to well thing. But the basic idea is that if you shut down a well, then the pressure can build, and then the oil can kind of squirt everywhere. And then when you open the well up again, you get a lot less oil out of the well. That's the sort of theory of what could happen. And it's certainly possible, because they're running out of storage, that they're going to have to shut in wells. The one thing I could say is that their production went from 5 million barrels a day to 1 million barrels a day because of President Trump's policies in the previous term, when he really put in tough sanctions on Iran to try to stop the nuclear program. And after Joe Biden came in, he just stopped the sanctions, and the energy production went back up to 5 million barrels a day over a couple of years. And so the Iranians, it took them a couple of years to get things fixed, probably with new wells and so on, because it can harm wells. But we have an experience of them being shut almost down to nothing and then getting back up.
Kevin, and partners stepping up to help. We're just hearing from the president here out on social media, so I'm sure this is the first time you're hearing of it. I'll read it for you. The Chancellor of Germany should spend more time on ending the war with Russia and Ukraine and fixing his broken country, especially immigration and energy, and less time on interfering with those that are getting rid of the Iranian nuclear threat, thereby making the world, including Germany, a safer place. I believe the German Chancellor earlier this week suggested that the president was being humiliated by the Iranians. Just what is the relationship like, Kevin, with our European partners at the moment?
I think that the European partners are feeling stress because their very unwise energy policies have exposed them much more to energy shocks from the Middle East. And it looks like the German Chancellor is losing his cool a little bit. And I would suggest that you take a deep breath and recognize that the best way for Europe to get its economy back on track is to, help us resolve this problem. And then also examine their own policies, which are so anti-free market that their economies are, happy when they get 1% growth. I think Germany's a great country. I lived there for a time, and I think there's a heck of a lot of potential for that country, but they sure aren't achieving it right now, and it's not just because of oil.
Kevin Hassett, we appreciate your time, sir. Thanks for making time for us this morning. Thank you very much, as always. The NEC Director, Kevin Hassett, there on the economy and the situation with the Federal Reserve. Just a note on the Federal Reserve. Resisting the temptation to turn up the heat and have a back and forth with the chairman of the Federal Reserve, Jay Powell. They clearly want to open the door for him to head to the exit.
They also want confirmation, a clean confirmation of Kevin Warsh to get him in before anything else. So right now, the White House is putting a clamp down on any kind of heating tit for tat between them and Jerome Powell, hoping that it will resolve itself in the intermediary. Really interesting, though. That is the time frame. They want the confirmation first, and then maybe the gloves come off.
Interesting note to finish the conversation on the difference between Europe and the United States right now. Of course, they feel the squeeze over in Europe. Of course, they're stressed. They have GDP running close to zero, and it could be zero if this continues. You can see the stress and the tension in the ECB news conference over the last 60 minutes or so. There is a capex boom driving this equity market and insulating this economy stateside that others just don't have. Europe just doesn't have.
Well, if you think about Europe versus the US, and this is the reason why you're seeing better economic performance and surprises in the US than Europe, not only does it have the capex boom of technology, it's also an oil producer and actually almost a net oil exporter for the first time. Well, Europe has neither, right? It doesn't have the tech boom and it doesn't have the energy reserves in its own place. So how do you then get yourself above this? This is what we heard Christine Lagarde dealing with, and this is the reason why you're seeing the economic data diverge.
Europe is struggling, which is why the president also wants Europe to step up to join them when it comes to trying to be able to open the Strait of Hormuz. The Wall Street Journal was talking about how a diplomatic cable was sent from the State Department to embassies telling their officials to press these foreign governments to help them in a maritime freedom construct to try to reopen up the Strait of Hormuz. But to Lisa's point, we are a net energy exporter. We will feel some of it, but we're much more insulated. Europe is not.
Fun morning. I'm not suggesting we do this every morning, but fun morning, right?
Oh, I think it was great. I mean, honestly, it's been such an active, interesting week. I could just stay here the rest of the day.
One more day to go, Bramo. One more day. Keep it together, okay?
Oh, I am. I'm doing great.
Coming up tomorrow, Ajay Rajajaksha of Barclays, Tom Forday of Maxim Group, Victoria Fernandez of Crossmark, and the NASA administrator, Jared Isaacman. Looking forward to that conversation from New York City. Thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance. Our player is back to take a look under the hood of the business of Formula One. Hi, I'm here to see TR Gatling. Welcome to my workplace. You feel pressure? Massive pressure.
It's the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard, oh boy. Can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days
You
ago.
can't even believe that. And the speed of the business has never moved faster. My career might stop, but I'd still be driving some probably very fast. This season, we're along for the ride.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. The stories informing finance with Bloomberg Markets. And rates, risk, and the cost of capital on Bloomberg Real Yield. A different topic every weekday, only on Bloomberg Television.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
The tensions are high.
Both sides are willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Looking to you from the bomb shelter.
This White House still pushing.
The analysis you need to make informed decisions fast.
Nothing is final until it's well and truly final.
The really important question is whether we'll get second round effects.
Nobody covers geopolitics like Bloomberg.
Hello from Bloomberg House. This is a special edition of Open Interest. I'm Danny Berger. We are in the heart of the Miami Design District as Formula One takes over the city. Matt Miller, he's close by, but currently preparing to kick off the day of high-profile interviews that will include the CEO of the Audi Revolut F1 team, and I'll also be sitting down with Thoma Bravo managing partner Orlando Bravo, and in just minutes from now, Scott Rubner from Citadel Securities. But first, let's check on stocks after a day of heavy news flow, including the mega earnings session. Meta and Alphabet are each adding $10 billion to their AI spend. Amazon and Microsoft are seeing major growth in cloud sales. Mag 7 AI CapEx in 2026 is on pace to top 700 billion. Only Alphabet, though, gaining. Meta down as much as 9%. At one point was down 10% at the open. Let's also look across assets, though, because oil has touched its wartime high. Iran's supreme leader vowed to dismantle the U.S. presence in the Strait of Hormuz and guard its nuclear capabilities like its border. Also, reports coming from Axios that Trump is maybe considering other military actions. And add on top of all of that, a Fed rate decision yesterday where you did have some dissent towards the hawkish direction. But still, it's a market dominated by the Mag 7 earnings late yesterday. Joining me here to discuss that and much more, I'm pleased to say it's Citadel Securities Head of Equity and Equity Derivatives Strategy, Scott Rubner. Scott, thank you so much for joining.
Good morning.
Lovely to be in your town, beautiful, sunny Miami.
Thank you.
So, okay, first of all, I know you called this the Super Bowl of earnings week, and that it was. I feel like
It was like a giant middle finger to traders for all of these companies to decide within 80 seconds of each other to report. Just how difficult is this for the market to absorb these big consequential earnings coming from these companies that are uplifting capex and kind of the entire economy of the United States?
Yeah, so we are not seeing any decline in spend and demand for AI. As we mentioned, there was the Super Bowl of earnings last night. By the end of the week, 66% of the market cap of S&P will have reported Q1 earnings. And from us, it's a very positive sign on the tech industry. And the way that you invest in the US equity market is one of high quality, high demand, high free cash flow, and it's unlike any world in the globe.
So if these are so attractive, why do we see swings like Meta down 9.5% on the day after it reports?
Yeah, so I would say that if I look at the run up into earnings and I take the semiconductor index, it rallied 19% over 19 days. And I think we're not seeing any real pullback in these names, despite the move in Meta. But I would just say when I look at equity futures today hitting a new all-time high, there's a big shift from what was a technical driver in March to one that is a fundamental driver in April.
How do you distinguish that? Because I could, for example, look at that OpenAI news on the Wall Street Journal that perhaps are not hitting their internal targets, and you get tech that sells off. And it wasn't just tech, it was like a momentum basket.
Yes.
Does really poorly. So on days like that, when it's selling, how much of that is fundamentals in the driver's seat, and how much of that is just taking some of the air out of the momentum trade?
I think the article happened to hit at an all-time high point in the momentum factor. I think that baskets are trading in the market more than ever before. So it was orderly to me. It was a buying opportunity. It was one that was factor driven, but it didn't change any views on the fundamentals.
Is it fair to say, though, that a lot of these pullbacks are just buying opportunities, especially for these quality big cap tech companies?
From our retail clients, we're really seeing that dynamic. So if I look at on Monday, we had a retail demand in the 94th percentile over the last 5 years. So I think when there is a sell-off, right now it's a buying opportunity, especially in the US mega cap tech stocks.
Has that been the case through this volatility, through the war in Iran? Are we seeing retail still buying the dip?
So I think that's a great question. Where you had retail really playing defense around tax day, April 15th was a big day where they were playing more defense and less offense. We've seen this completely change. So retail had a very good trading year in 2025. We execute between 35 and 40% of all retail flow. So we see this with data-driven insights. But now retail moved back into the driver's seat after especially one big beautiful bill act and tax refund checks hitting the accounts. I think we're seeing a return from retail. It's no longer meme stock trading, but it's one that is, they're driving the price action.
What does that mean for supply demand? And you're always really brilliant here, because if you have retail buybacks coming back, hedge funds still participating, is there a real imbalance that could push stocks higher?
There's a supply and demand mismatch right now, Danny. So when I look at corporate earnings, given that you mentioned it, so next week starts the start of the buyback window for corporates. If I look at US corporates, they authorized $544 billion year to date, over $1 trillion worth of repurchases this year. It'll be the largest year on record. So stock certificates are now a rare commodity again. And, by my calculation, I see about $5 billion worth of corporate demand every day during the open window, which negates some sort of the selling pressure. So US corporates, again, are the biggest buyer of the stock market, and US corporate CEOs are showing strength in their views on the market.
If I just took everything you just said, it's very easy to be incredibly bullish on this market, and it's indeed not just easy, but logical. But then another part of my brain, Scott, goes to oil trading at 4-year highs, yields moving higher, 30-year yields surpassing 5%, and at the same time, the VIX is 18. It does feel like a bit of a disconnect. Is that fair? Is there some irrational exuberance in markets that other macro cross assets aren't really reflecting as well?
Yeah, so the way that I view cross asset volatility and oil prices, you mentioned the 10-year bond hitting 5%. So there's a lot of reasons to run this wall of worry, especially on the software side and private credit. But when I look at the participation of who is trading the equity market, it's almost a macroeconomic indicator. when I think about the bottom 50 percentile of wealth demographics, we've seen equity exposure ran by 300% since 2022. So it's almost a resilient consumer, one that grew up on the trading apps, trading all the exchanges and after hours type of volumes. That to me is, as long as there's no displacements from AI in the jobs world, it's something that we're really bullish on.
Can I say why I love that? Because we look at a lot of things like University of Michigan and sentiment looks really poor.
Yeah.
So I feel like this is a better way to kind of gauge, because it's a consumer that keeps spending and clearly continues to buy stocks too.
We actually have our own sentiment indicator that we started publishing. Citadel Securities executes between around 24% of the US exchange on a daily basis. And what I find with our indicators is we're actually real-time back testing this on data. And our indicators are a lot more euphoric than what the sentiment indicators that we've seen.
Did they take any hit with higher oil prices and the war in Iran?
I would say that it was a quick mechanical-led sell-off in March. It was very robotic on degrossing portfolios among institutional investors, but our retail clients were actually, slowly entering into the market, and we've rallied pretty aggressively since then.
By the way, since degrossing, have institutions regrossed up? Where do they stand in exposure?
Yeah, that's a good question. So hedge funds gross exposure, which is basically longs plus shorts, if I look at back to March, was at an all-time highs led by the shorts. And if I look at net exposure, which is longs minus shorts, that was at lifetime lows. So you had this dramatic need to hedge based on rules. So it was shorting ETFs, it was shorting index futures, it was buying put options. That all happened in March. The market healed dramatically since then. Hedge funds are slowly participating on the way up, but retail's really the price setter in the market.
By the way, what difference does it make, I guess both for institutions and for retail, to have these huge IPOs coming to market? So much has already been said about the concentration in tech. And now we're about to get $800, $900 billion companies, even more when it comes to SpaceX. What difference does that make to have such a change in the composition of this equity market?
So when you think about the S&P 500, if you allocate $1 into the SPY ETF, 35 cents goes into the Mag 7, 40 cents goes into the top 10 stocks. When you think of what percentage of the US equity market is AI or AI adjacent, it's 45 cents of every dollar. So when I see the distribution, I find the US market remains very robust in terms of rebalancing. So there will be some of the big names have to be sold to make room for new IPOs. We've done a number of work on this, but it's not a net negative. It's something that is based on all of these passive flows that go into the US market based on target date strategies that make all companies higher in a market capitalization basis. So when they enter the market and go into these big indices, it's actually quite bullish for the US versus the rest of the world.
Interesting. So if you were running a portfolio and you'd want to kind of prepare for this, like what do you advise?
It's one that naturally the biggest weights need to be sold to make room for these new IPOs. The interesting dynamic is that retail will actually get a decent slug of the IPO allocation. And this is a new phenomenon in 2026, something that we're actually quite
years. Prices are 3.5% higher than they were a year ago. One reason why, the sharp increase in gas prices amid the war in Iran. AAA says the national average of $4.23 a gallon's the highest in 4 years. That led to protests at places in Michigan. Jill Murphy was taking part.
I've known a few people already saying they don't know how they're going to get to work because it's so expensive right now.
Not all the economic news was bad. The economy grew at
and on the dome, it is the immediate situation. So we can actually see much more details, because sometimes if you don't see the numbers on the dome, that means you have no way to distinguish between the market maker and other participants. When I see the numbers on the dome, I can split between the market maker, who is always jumping up and down and changing their position, because that's what they're doing. But most importantly for me is that other traders who are seriously sitting there And I want to see the difference between the market maker on the DOM and other participants by the ID that shows me the size, because market maker usually they have the exactly the same size. That's 200. You can see it on gold very easily: 100, 150, 240, 300. That's what they do on the gold. Easy to see, easy to spot. They always move that on the same distance between the price line. Okay, it's easy to see the market maker. Now, this particular detailed DOM, this is the MBO market by order DOM, which people call like third level 3. Okay, but it's a nickname. There's no level 3. It's basically level 2, but the people in the jargon saying it's level 3. Anyway, so this is the level 3, or actually level 2, but detailed level 2 information on the passive side. And you can see, by the way, you can see how they form the icebergs. You can see even formation of the icebergs at the very DOM. You can see that they put container for the volume one load, and then they fill in that container with 10, 20, 50, 60, 100, 600 lots into the one small container to put everybody on a market. Our DOM is capable to show you that. You can see that in real time. I actually have the demonstration on our website, so you can watch the videos. Anyway, and the historical record of the passive orders on the heat map. So the heat map is actually what provides the liquidity and defines where the bottoms and the tops. As you can see, this is the market, this is the candle, and actually this is the top of this range, which we climb it, and you see the reason why this top is formed over here, because there was a resistance on the way. First, it was about 48 in volume over here, and then it was about 81 in volume over here, sitting for a long time. And so the buyers exhausted. I mean, they get thinner, and then they saw that at the very top out there is still sitting, by the way, in real time. There is in real time is about 32 in volume, but it was at the moment when this top was formed, it was about 69, 67. Okay, yeah, about the 67 plus minus in volume. So the buyers were like, yeah, they bought this liquidity. Yeah, here we go, we're going up. They bought this liquidity. Here we go, we're going up. We bought this liquidity. We don't have more power. Now, what you're seeing over here, that they being probably some of them stopped because of these passive sellers sitting right over here. This is the passive sellers. And now, if you take a look at each candle, you can see easily what's interesting. You can see that these buyers, and it's on a footprint. Footprint is absolutely, you can't replace the footprint. Okay, it provides you the detailed information on the aggressive side of the market, buyers and sellers. Okay, buyers and sellers. And now you can see that over here, 49, 58, 63. Those buyers created imbalance on the way up. But they being smacked by the level 2, and you see these rectangles, pink rectangles, that shows that the price traveled down in this candle. And this is the clearly absorption. What is this telling me? It tells me two types of information. First, of course, you can see that in this candle, the buyers get exhausted. You see 1, 5, 1, 10, 20, okay? They get exhausted. After they were very active in this candle over here, in previous candles over here, they were very active at the very top of the candles, which you can see with the bluish colors. But then they start to get exhausted. Okay, just a 0.1, 0.5 at the top of the candle. That is a sign of exhaustion. You can see the few waves of exhaustion. And now you can see that they tried to go again, but the level 2 didn't let them. Okay, so now that is the absorption. And these rectangles is the absorption indicator on the footprint. Now, when you see the absorption first time, let's take a look what happens right after the absorption. Keep in mind, these buyers now sitting in the trap. Sitting in the trap buyers don't think that they are not deactivated. It can be a sleeping giant that can drive as a magnet the price back to that price level. That's interesting. When you see a large, humongous trap buyers or sellers, most likely price is gonna come back at least to mitigate or to touch that price level, at least. So it's becoming a magnet. Now that's part of my selling or my strategy system. Okay. Now this is the trapped buyers. The price travel away. The price travel away. At the very top of this candle, we can see sellers 0, buyers 1. Oh, not too much. 2, 3, 8, 10. Not too much. This is the exhaustion. This is the exhaustion. This is the exhaustion at the very top of the candles that tells me no, the buyers doesn't put their themselves over here, over here, over here. They exhausted. When you see the sign of exhaustion, that is a really predicament that the price will no longer be try to go higher. Although it's trapped in buyers sitting there, you need to wait other signals, which I explained on another videos, for you and me to actually start trading the pullback. Now it's too early. Now it's the reason to sell because exhaustion at the very top of these candles, and you see that there's a formation of the blocks of delta. This is in red, delta block sitting on this very candle. And by the way, we show you the fastest delta because other indicators show it at the bottom or up, and they show you in the Excel chart down. We don't provide you like Excel chart. You need to calculate the numbers. You can see visually while this candle is forming, the delta block is minus 27 sellers in this very chunk of this candle. Wow. Okay, minus what? 194. So do you see the delta blocks over here for buyers? No. You see sellers, delta block, sellers, delta block, sellers, delta block. So now, is that a signal to start selling? Where is the best position to do that? Actually, when you see this large delta block, you can start selling right over here. When price return to this candle, kind of retested this delta block, you can start selling from here. This is the, if you miss this candle, you can start selling right from here. This is the A type of the set. You can grab 8 ticks, 10 ticks, 20 ticks, depending on the situation. Okay, that's how you combine structure and volume indicators. Most wise, most experienced, most profitable traders, they combine the price action with the X-ray of the volume indicators, specialty indicators that are build, those indicators build purely based on data, because in data, we trust. We don't trust brokers on some freaking Forex exchange who can mess up with whatever the numbers and give you whatever they want to see. But here is nobody can lie because it is a centralized data exchange, CME data exchange or exchange, okay, marketplace. So now this is really a solid indicators that you can be certain by looking at the numbers, and visually we can present them with some rectangles as the absorption or even
the big players are the whales of the market, and it's usually them that spark the big trend. They hide their intent.
Sabadão chegou, a coisa esfriou, você não saiu para balada? Não fique triste. Botino acaba de chegar aqui para esquentar a sua madrugada.
The same magnitude. Yes, they raised, but it was a very slight increase. And that kind of goes to show that Alphabet, out of all the hyperscalers, has the best capex efficiency. The best capex efficiency. They are able to use their compute across their apps, so their search, YouTube. Also, the cloud business is growing at the fastest rate compared to other hyperscalers. So that capex efficiency is what's driving a lot of the margin upside, and it's reflected, in their numbers and guidance. So even though it was a beat and raise from everyone, Alphabet's beat and raise was the most impressive, and hence the stock reaction.
Mandy, where do you think we are in this hyper investment phase?